I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views, which you can find online at cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
Equities in both Canada and the U.S. have hit record highs. Does this mean anything that we should pay attention to, or is it a warning sign?
Let's talk about that. I need to clarify some things. I think I've been talking about the train too much, and we just need to walk through and clarify some things. Let me say this. Back on November 4th, we had an intermediate degree cycle low. On November 10th, we had a Dow theory primary bullish trend change. And within the context of that, there's been a couple of short-term buy signals, and with the latest being on February 3rd. And as of this interview, all of those signals still remain intact. So, I'm not standing in front of the train, but it is a train. Let's talk about the train now. Coming out of the 2002 low, the 2009 low, we saw the most extended four-year cycle advance in history. We've talked about that in great detail. As we moved into that top, it extended and extended and extended and extended and extended, and we've talked about why, and we all know it's no secret. It's not conspiracy. It is what it is. All the liquidity campaign across the globe to stretch and extend, and successfully it happened, and we created the longest four-year cycle advance in history. But we finally saw the Dow theory primary bearish trend change occur in June 2015, and that was followed pretty much immediately in July and August by the weakness into what turned out to be the low in the industrials occurred in August, and then on pretty much every other index on the planet, it occurred in January, February of 2016. And, as we moved into 2016, well, let me say this first. In January, February 2016, that primary bearish trend change was confirmed, actually. So as we moved into 16, that's where we stood, and then we spent all of 16 pretty much in no man's land. And the reason I say no man's land is because the averages never could blow out the previously established primary bearish trend change. We talked about that all year. It never happened, and the market it just chopped, and then it flatlined through the summer, and then finally come November, we saw the primary bearish trend change reverse with a bullish trend change, following the election. And at that point, it proved that the 2015-16 low, I say 15-16 because on the industrials it was August of 15, on everything else it was early 16, that was a four-year cycle low. So since November the 4th and the primary bullish trend change on the week of December the 10th, or on December the 10th, I think it was, this advance has gone parabolic, and it is what it is. Does that negate the fact that it's a bubble? No, not at all. In fact, the fact that we until we see our DNA markers reappear and ultimately the triggering of another primary bearish trend change, it can continue to expand. And so from that perspective, I'm not standing in front of the train with the story here. The problem has been that we have not seen a normal correction of any degree since 2011-12. The 4-year cycle advance, like I said, the longest extension ever in history. We had that little decline into August of 15. And so, you know, the extension has just continued to extend. And so from that perspective, that is the problem with this advance. Do we have a intermediate and longer term buy signal? Absolutely, yes, it's there, but it's happening within the context of the bubble. That's the thing I want to clarify. Now, at present, I have we're at intermediate. I have some intermediate degree timing coming in. We have those lows coming in March and April. So, you know, the fact that this is pushed this far toward that window for the lows, that's okay. I mean, yes, it's pushed, but the lows are still due in the next, I don't know, call it 6 weeks to 2 months, something like that. So those lows are out there. I think we're going to see the market roll over into those lows. What happens from there? Not sure. You know, anytime you roll over into an intermediate degree low and out of an intermediate degree top, it's the opportunity for something bigger to happen. But given the current setup, I'm kind of not sure that we're going to see anything of substance there. It's probably going to be a little bit down the road. I mean, not to say that you couldn't see a major top with this intermediate degree cycle top. That's not at all what I'm saying. I'm saying that if in the event that were to happen, it's not going to be able to confirm until the next intermediate degree top based on the structure that we have in place here. I just don't see the thing falling in place quite that quickly at this point. That said, the danger with this market, and you know, talking about being a bubble, is that people don't see the bubbles. They never do, and they don't understand the environment that we operate in. You know, no one ever sees the bubbles. If you look back, you know, who saw the commodity bubble in 2008? Remember everybody talking about peak oil? And you know, when it was at $140 a barrel, it was going to $200 a barrel. And, you know, I don't know if it was luck or what, but my DNA markers, the statistics fell in place, and I called it to the week. So, I saw it. Housing, 2005. Who saw that? You know, I mean, I think it was Greenspan himself said that housing wasn't in a bubble. Of course, that was probably propaganda to convince everyone else. But my point is, who saw it? I know down at the condos, I heard real estate agents talking about down on the beach how it was like they equated it to the New York Stock Exchange floor, where they would get calls and they'd say, "Hey, I got a 3-bedroom, 2-bath on the 12th floor of so-and-so condo," and they'd go, "Sold, I want it." And they literally were selling them like stocks. Who saw the bubble? They thought it was a new norm. And so the point is that be it, you know, the tech bubble in 2000, the commodity bubble back in 2008, the housing bubble, the sugar bubble, which I put in I had a great little article or write-up about the sugar bubble back in the early 70s in the last letter. I hope maybe you read that. You know, people, you can't see it. You get caught in the moment, and they try to justify things as a new norm. And so that's one of the dangers with these bubbles, is you know, people try to get their mind around it and put it in a box and justify it as some kind of new norm, and it's not. The other danger with these bubbles is that people like me, and I'm sure there's other technicians out there, there's not many of us that I think see this for what it is, but I know there are some. You know, I don't know how to say this except say it. I mean, we've been in effect wrong. We see it for what it is. We look at it based on history. I mean, there's never been, and it's not an excuse, I mean, it is what it is. There's never been an extended 4-year cycle like we saw going into the 2015 top. Who have ever in their right mind thought that you would have seen that mediocre decline into the 4-year cycle low, and that was it, and that it would extend further? You know, and so we're outside of the norm, and that makes it difficult. It makes it difficult for people to see, people to understand. It makes it difficult to call. So yes, bubbles can stretch further than you imagined, and that's where we're at with this advance. But until we get the DNA markers back in place, And until we see another Dow theory primary bearish trend change occur, hey, I don't know. It's going to continue to stretch until those things happen. Now, when those things happen, then I am more bearish than ever because I know how all parabolic advances end. I know how the 6,000% advance in sugar in 1970, whenever it was, ended. I know how the commodity bubble in 2008 ended. And this will be no different. It is a bubble. But for now, hey, it is what it is. And I'll go one step further. And I'm not playing politics because I don't care if Donald Duck had been elected. That's not my point. The real point is that, you know, you see the blame game going on with politics, and I guarantee you, I don't see this president getting out of office before this thing goes to hell in a handbasket, and I think he's going to be the patsy. I really do. It's going to be interesting to watch the politics and the blame game once this thing does come unwound. But until then, like I said, and until we get our DNA markers, hey, it's got a green light to stretch on.
We'll have more with Tim Cyclesman Wood right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, you just finished publishing an article in Stocks and Commodities magazine. What was the article about?
It was an article entitled "The Illusion, the Grand Illusion," I think it was called, and it's about the bubble, you know, and how extended the market is, and you know, how it's likely to end. But anyway, yes, that's in I think it's the March issue of Technical Analysis of Stocks Commodities magazine.
What kind of lesson are you trying to give people or draw attention to?
Nothing. It's just trying to point out the environment. That's the thing. Like I said, the frustration is that we're operating out of all norms. We've never seen anything quite like this. I mean, like I said, there literally has never been such an extended 4-year cycle advance. There's never been, it's a lot of first here. And again, it's not to make excuses because it's been driven, I think, based on liquidity and so on and so forth in the attempt to hold things together. We all understand that. But the fact is that, you know, it is extended. There are some abnormal things going on because of that has extended these cycles, but it doesn't negate them. You know, the same liquidity caused the housing bubble. The same liquidity created a commodity bubble. The same, you know, there's always something behind the bubble that people want to look at to try to justify it. You know, this time is different and it's happening because. Well, you know, none of that really ultimately matters. It's gonna run until it exhausts itself, and we will see. That's the thing. We will see the setup. It will happen. A Dow theory primary bearish trend change has to happen. It's a structural phenomenon that has occurred at every 4-year cycle top since the inception of the averages in 1896. And, you know, you can get the tippy top before you get the primary bearish trend change, but you're not going to get the bursting of the bubble until we get that. And so, you know, I know how the story ends, and like I said, for now, the warning is just understand the environment. And that all said, look, there's opportunity here, and I'm going to talk about it, in my research letter when we get to the next intermediate term low. If we don't see DNA markers in place and we don't see anything catastrophic happen or any major warnings, that's the time to jump on the Bubble Express. It's opportunity. So, the message is not all bad. I'm trying to put it in context.
Of course, and when you jump on a bubble, it's a pretty dangerous ride, isn't it?
Well, it can be. I mean, you need, again, that goes back to the message. If you understand the environment that you're operating, then it maybe not. It can be quite the opportunity. Because look what's happened since November. Look at the advance. So everything cuts two ways.
We'll have more with Tim Cyclesman Wood right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Tim Cyclesman Wood. Tim, gold and oil. You say you can't talk about one without talking about the other.
I can't talk about gold, oil, the entire commodity complex, and really even equities. It's amazing how, everything is kind of moving together here. And if you think about it, and people can go back and look at charts and kind of get their minds around this, but let's start with gold, though, and then I'll digress. Let's start with gold, and then I'll come back to this. 2011, we knew was a 9-year cycle top, identified it, and I have said for years that the target for our 9-year cycle low has been 2016-17. Well, we moved into 2016, and we got, a low in gold people got excited about. I said, no, that's not it. We got the low actually in December 2015, and people got excited about that low. Then we had the secondary low in December 2016, and people have gotten excited about it. And I've said, no, that's not it. It's occurred. It doesn't fit without getting all wordy and trying to explain it in an interview. It just doesn't fit for the cyclical phasing. There should be another trip back down. And I think, long story short, and I still see, and I've told you, we've talked about this for, since the rally out of the December low here has taken root, that I think this is a counter trend advance, and that there is another trip back down in gold. Last I looked, gold's off, $16 or so today. That's not, in the grand scheme of things, that's not a big deal. But I think that trip back down may have begun is the point. And, ideally, based on the 9-year cycle, we should see, and I've been saying this all along too, we should see an undercutting of the December 2015 low for the final 9-year cycle low. Now, let's assume this time is different. Okay, fine. There's still another trip back down. We're still at an intermediate degree top. We still have at least a retest of that 2015 low. If it holds, great, then it's proven this time is different. But the expectation is that it's not going to hold until it proves that it does. And either way, like I said, based on the cyclical phasing, we're looking for that leg down. Now, that's not just based on gold. Where I was going with this is if you look at the CRB index and you look at gold, at crude oil, and if you look at copper, or if you dig into some of the other metals and you look at tin, and I did this, and I looked at lead and nickel and off-the-wall stuff that nobody even thinks about on a daily basis, or even soybeans. Everything, all commodities, most equity indexes, everything made lows in late 15, early 16, all in that same window. Now, depending on what it was, with the CRB, there's a 3-year cycle. With gold, that just happened to be an intermediate degree cycle low. With crude oil, it was at least an annual or slightly longer intermediate degree type low. With equities, it was the 4-year cycle low. But the point is everything rolled. I mean, you can pull up the charts, overlay them. There they are. Everything, boom, 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 into those lows, and everything has advanced out of those lows into the more recent highs. And now here we sit at the intermediate degree tops. And we have seen the roll in the CRB. It's begun. It's trying to take root in oil now. I think oil has at least a retest of its previous low as well. And then we're also seeing it, we're sitting at the same intermediate degree cycle tops in equities. So everything is positioned to roll back down, and that's going to really be the test. And there's some statistics. You asked me several interviews ago about commodities, and I've been able to look at them a little closer and get the statistics and analysis, in my head. The key with commodities, here's the thing. Let me try to put this in perspective. Everything has moved up together out of the same basic cyclical lows. That's good and it's bad. It's good in that, if you see one crack, then maybe it's a warning that there's going to be a crack in the other, that everything's kind of moving together. The bad is that it makes for a house of cards that if one goes, maybe they all go. And so the danger that I see here is that everything's moved together. Now we're at these cycle tops, and the test is at hand. What's going to happen? Well, I don't know. But the expectation is that gold probably is going to make a lower low. Crude oil is going to test its low. Equities is at an intermediate degree top, or it should be, and rolling into the intermediate degree low. It's the structural developments as we move into those lows that's going to matter. And you asked me specifically about commodities, and I got caught up and did the research on that. And here's the deal. It's not so much the decline here, it's the next advance that's going to tell the tale. The next little intermediate degree advance coming out of this low in commodities. There are some statistics with the CRB that can be a death sentence to commodities, and that's the test. Can commodities pass that hurdle? And the way I was able to make that call back in 2008 was that hurdle wasn't cleared. It went right up to the hurdle and gave a sell signal without clearing the hurdle, and it was a death sentence. And that's where I'm going with this 3-year cycle with commodities. Either it's going to clear the hurdle or it's not. And we're not quite to the hurdle yet. And before we get to the hurdle, we got this intermediate term decline to deal with. And I think we're there pretty much across the board.
Tim, thank you so much for chatting with us.
You're welcome.
My guest has been Tim Cyclesman Wood. You can find his articles on timcyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Any questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.